Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. It's been another wild week in markets, with the highlight being the collapse in Bitcoin. At one point, it was down 40% on the week. There's been a zillion commentaries on these moves, and I published my own take at the start of the week and before the collapse on how to think about what drives Bitcoin. You can find it on the Macro Hive site. Outside of crypto, we published some excellent pieces on the equity outlook, UK house prices, iron ore prices, and we also featured a guest deep dive on whether Milton Friedman's plucking model captures the business cycle better than what central bankers currently use. You can access all of these pieces by becoming a member of Macro Hive at macrohive.com. This also gives you access to our entire archive of market analysis and to our member Slack room, where the Macro Hive team and members discuss markets all hours of the day. It's refreshingly different from Twitter. When you sign up, the first month is free, and then it's only the cost of a few weekly cappuccinos. It's well worth it, and many call Macro Hive the hidden gem for investors. Once again, sign up at macrohive.com. Now, on to this episode's guest, Themos Fiotakis. Themos is the head of research at the macro hedge fund Glen Point Capital. His previous roles included being head of fundamental strategy at UBS and head of EM FX strategy at Goldman Sachs. I regularly speak to Themos, and he's one of the sharpest macro thinkers out there, and he's been spot on in terms of market views so far this year. Now, on to our conversation. Welcome, Themos, to the podcast. I've been looking forward to our conversation for a while. You're somebody who I listen to a lot, and I always enjoy reading your comments and engaging with your comments in our Macro Hive chat room that we're in. So welcome to this conversation.
Well, Bilal, thank you so much for the invite. You're fostering one of the best dialogues out there. I'm very, very appreciative of the time you're giving me.
Great. And Themos, before we sort of jump into kind of markets and the economy and so on, I always like to ask my guests their origin story. So, what did you study at university? And after uni, was it clear that you were going to enter a finance career? And then where did you end up going? And what's been your journey up until now?
Well, I did my grad school at the LSE, and right at the end of my master's, I started my PhD. And, I wanted to do a thesis about the asymmetric payouts versus the risk involved in finance. And my professor back then, who was coming from the Chicago school, was saying that this didn't work in the real world where markets were efficient. So after that brief friction, I decided that it made more sense for me to be in markets. More seriously, I had a chance of going to work with Alberto Ades back then at Goldman Sachs in New York. I took that chance. It was a fantastic experience. Then I moved to London in around 2007, 2008. I learned tons by being involved during the crisis with emerging markets, later on with Greece. Towards the end of my Goldman career, I was running foreign exchange strategy in emerging markets. And then I moved to UBS around 2015, where towards the end of my career there, I was running basically global foreign exchange and fixed income research. A year and a half ago, I moved finally to the buy side. It was something I wanted to do always, but I always wanted to do it with a team of people that I'm close with, and the Glen Point guys and Neil Phillips. We've been working together as a client to a researcher. So we made that relationship a lot more formal, and last year and a half or more at Glen Point Capital, and I'm running research here.
Great. That's excellent. Yeah, and you're working with a great bunch of guys there. Now, in terms of the kind of the macro picture, maybe we can start just with your kind of base case, your base assumptions. I mean, what's your view of where we are in the cycle, say for, let's take the US as a starting point, and then we can kind of go from there.
Yes, I find that for us macro guys, there are two types of great opportunities. The one is when a trend is playing out to figure out how much further it has to run. But that is not usually a very rewarding exercise. I guess the most rewarding exercise for us in macro is to understand when there's something reasonable to expect about the future, but the market is priced to expect something more extreme. And I think we're in one of those places. The market has seen an enormous stimulus in the US in numbers. It hasn't been too diligent in understanding the fine details behind it, and it has extrapolated an extreme kind of growth and inflation picture from the US. And up until recently, an imbalanced one as well, where it didn't sort of translate to other parts of the world. If you look a little bit more closely, you find that the US fiscal package is huge, but it's also very wasteful. For instance, if you compare the US fiscal package with the outcomes that the European packages have delivered, they have delivered lower unemployment rates and more stable sort of like product markets. In the US, the huge sums of money haven't prevented a very large amount of small companies from shutting down and the labor market from not recovering as quickly as it should. Plus, the trade deficit exploded. So there was a lot of slippage. And second, it has created this very anomalous reopening where I consider it a mess, where basically you have seen things like the ISM come off or consumer confidence come off, while at the same time you had supply pressures and spikes in prices. And I think that while people think of this as some kind of explosive inflation process, I think of it as a process that will normalize at some point to something a little bit less extreme, and B, as something that is a lot less efficient as a stimulus program as people think that it is. So the way I think about it here is that there's about 35 basis points of pent-up inflation month over month that needs to be still seen in the numbers, but that can actually be offset by this huge spike in used car prices. And after that, US inflation will moderate quite a bit towards the end of the year. In fact, I believe that by the end of the year, we will be talking about a low inflation outcome and we will be talking about the Fed doing the right thing. Second, I would note that the labor market, even in high frequency metrics, is recovering a lot slower than people are making it to be. There's a lot of intellectual excuses around that, but it is what it is. I don't think that's a problem, but I think that implies that, again, the Fed doesn't need to react extremely here. And most of the people who are close to the Fed and all of our channel checks are saying that the Fed wants to be patient with everything they're doing. I think you've touched on a number of these points in your research as well. And I think that the reaction function is one where they don't want to make the mistakes of the last cycle again. They have and they can afford the time.
Yeah. And on the labor market, many people are pointing to things like the JOLTS numbers, which, are at very high levels. At the same time, there's lots of measures of difficulties of finding labor. You're also hearing of wage increases, signs on shops, asking for having sign-on bonuses and things like that. So you're having all of these kind of data points and anecdotes. Some of those, how do you interpret, those points?
Look, I don't doubt that there is this imbalance between demand supply of labor at this stage. But this is not inflation. This is the economics of flipping a burger haven't changed, despite the fact that McDonald's cannot find burger flippers at the moment. So what it is basically a one-off kind of a pressure between supply and demand. And that probably means that there's going to be less hiring now, more hiring later. But also, some of those data points that people look at, like, for instance, JOLTS, they have typically overstated the labor market's health in the past cycle. So I take it with a little bit of a pinch of salt, and I look at broader labor market indicators, which the Fed is looking at as well.
Yeah. And then how about China? Because the funny thing about China, I find, is, unlike, say, 2008, 2009, where they did the massive stimulus and there was a lot of focus on China saving the world, this time China's obviously they've dealt with the pandemic in a different way and it's more managed. But at least this year, there hasn't really been much conversation about China. There's been some focus on the credit numbers, which have come off a bit. But it's almost like China's kind of in the background, just humming along. Is that a fair way of looking at it? Or is there something interesting going on in China?
I think that's absolutely fair. It's always very hard to have any kind of forward thought about China because they make up a lot of their policy as things happen. Like this new policy about not allowing commodities to go through the roof is a new thing, and it's an introduction to the market that has made a big difference over the last few weeks. But generally speaking, I find that they're quite thoughtful in what they want to achieve. And I find that they are managing their monetary cycle and their fiscal cycle in a very sort of like fine way so that they can avoid boom and bust cycles. And I think that doesn't necessarily mean something explosive as an outcome, but I don't think that they're going to be falling off of a cliff anytime soon. They want to maintain a certain level of activity momentum here, and they have the space, I think, to deliver it.
Yeah, that makes sense. And we just round off sort of the other big economy, the euro area. Any thoughts on the euro area and the ECB?
I think that, obviously there was this reopening trade, and the peak momentum for Europe is still ahead of us around Q3. But I think that that's now more in the price than ever. There's a big consensus trade around the Bund, and it's becoming increasingly in the price. The ECB's relationships, internal relationships, are the worst they have been in a decade or so. The June meeting will be a meeting where two very different camps that don't speak to one another will come face to face. But given the situation in bond markets, I doubt that they're going to do anything more than technical adjustments, and the market sort of like expects that. So I'm not expecting fireworks from Europe anymore. I mean, it was a good trade when the euro was at 117 change. Now it's a much more balanced risk reward, I think, although there's still, some upside, I guess, to European trades. Where I think there's a third kind of or fourth kind of parameter here for markets as a block, and which we can discuss later, is the emerging market block, like the non-China emerging market block, and particularly LATAM and CEMEA. And I think that that's the place where people are not looking at.
Yeah. Actually, maybe let's go on to those, actually, while we're kind of along these sort of subjects. You're right. I mean, people tend to focus on, when they think of EM, there's been a lot of focus on Asia, in the recent period when they do look at EM. But of course, EM is very heterogeneous, There's many different types of EM, and so tell me more then about some of these views on CEMEA and LATAM.
Yeah, so I mean, look, first you're dealing with countries, whether that is India, Indonesia, whether that is Russia, South Africa, whether that is Mexico, Brazil. You're dealing with countries that have had a very conservative approach to the crises. So they haven't overspent despite the deterioration of the fiscal balances. Most of it is cyclical. So at the same time, they haven't had huge lockdowns. So the level of herd immunity, to the extent that something like that exists, is high. And given the huge acceleration in the production of vaccines, they will be in a place to vaccinate at a high speed by the end of Q3, beginning of Q4 en masse. So I think that the same trade that you saw in the euro, people thinking about the reopen, you'll start seeing it in emerging markets. And that's number one. Number two, what a lot of people have tried not to follow, because it hasn't been a great guide in the last few years, is the terms of trade. But the terms of trade shock is now something you cannot ignore. And there are countries that are receiving a generational kind of a boost to incomes through terms of trade, whether that is Brazil, whether that is South Africa. There are some massive benefiters out there. And you're seeing that. You're seeing that in better fiscal performance. You're seeing that in their trade balances improving a lot. South Africa is running one of the highest trade surpluses in their history. And it's not just domestic demand, it's also the export side, the pricing. And equally, they have policymakers who are hiking despite the fact that the real rates are reasonably high versus the US from a historical perspective, at least the forward real rates. So I think that there is a nice, very macro trade lining up for emerging markets, and it's just at its infancy. If you look at positioning numbers, any kind of short dollar trade tends to occupy the G10 space much more than the emerging market space. And valuations favor it as well. So low positioning, good valuations, good macro. I think there's a good trade ahead for markets around there.
And if we talk about, say, two of the more sort of troubled, so to speak, markets in LATAM and CEMEA, say Turkey and Brazil, I mean, how do you view those?
Well, Brazil are much more favorable than Turkey. I mean, my favorite CEMEA market is South Africa, but I don't want to derail the conversation from where you put it. Brazil, I think it's lining up to become a beautiful trade. There is some political noise, but that's still far away from us in terms of time. A lot of the fiscal risks are now behind us. Their fiscal performance is improving. The terms of trade have helped the country a lot. Trade balance, external balance is all in great shape, and the currency has lagged every single other currency, virtue of the fact that they have had very low levels of interest rates. But the central bank is now hiking at an 75 basis points base, and they're surprising on the hawkish side. They could reach a level of policy rate north of 6%, pretty, within a reasonable period of time. And the curve should at that point flatten, which is a point that emerging markets tend to see stronger currencies. And that is the time that inflation will also be peaking. We're not too far from that point of time, actually. Next couple of months, inflation will be peaking in Brazil. So real rates will be widening on a forward basis. So I really like that trade. But I do think that there's more participation there than elsewhere as a trade. Turkey is a difficult one. It's a difficult one because the politics for Erdogan are deteriorating. And as he is slipping, as power is slipping through him, he will be tempted to boost the economy because it's the economy that is mostly hurting him. And that is always a tricky place to be when it comes to Turkey. So far, they have done well fiscally and monetarily, but I'm just, you cannot be too vigilant in terms of the point that they're going to turn around and turn more stimulative again.
Yeah, understood. And you mentioned sort of South Africa is your favorite senior one. You mentioned the great trade balance numbers. I mean, what else is it about South Africa that makes it a good story?
So what you would expect from a country that has had a destruction of domestic demand, in terms of trade boost and a huge accumulation of savings, would be to see assets domestically to trade at premium, like trade very richly to other things, not at a discount. And when you're looking at the level of the currency versus valuation, or whether you're looking at the curve is one of the steepest things you've seen in emerging market space outside of a crisis. So there's a huge risk premium there. There's a generational terms of trade shock, dilapidated domestic demand. This looks to me like Brazil used to look in 2003, around 2003, right before it started this crazy rally that led it from 4 to 1.5 within a few years. I'm not saying that that's going to be the equivalent, but the currency trades like it's having in terms of trade shock.
Yeah. Okay. No, it sounds like a really quite kind of good story. And, on this terms of trade side, we've seen some big commodity price moves over the last year or so. I mean, which ones are you focusing the most on? And presumably the reason you're focusing on it is because it has a broader impact on other markets. And if so, which markets you think should respond the most?
I mean, obviously, we are looking at things that have an impact both in emerging markets, but also in broader markets like oil, gold, etc. But we're also quite interested in how metals that are linked to ESG factors, such as copper or aluminium, how these things are doing. And if I could classify it as a commodity, I would say that I'm pretty fascinated by these carbon emissions futures as well. I think all of these three play an underappreciated role in terms of the new kind of post-carbon emission world.
Yeah, no, absolutely. That makes sense. And, in terms of your broader equity view, I mean, do you have a base case on equities as a whole?
I think equities are the toughest here. We have seen some kind of peak stimulus. We have also seen peak demand in the US, and the valuations in a number of those places are very high. I mean, don't get me wrong. When you get a company like one of those companies that is in ARC, like Twilio or CrowdStrike or all of these future technology companies, they're phenomenal companies and they're going to be growing, etc. But when you have valuations that are in the triple digits, I mean, they can be a phenomenal company and they could be worth 200 times their earnings, or they can be a phenomenal company and be worth 150 times their earnings. And the difference between the two valuations will be just a flip of a coin, basically, right? So I think there's a bit of one needs to tread carefully with stocks. I don't think that there's a bear market here, but I think that the easy money is behind us.
Yeah, no, that makes sense. And more generally, in terms of risks, either to your own view or more generally for the market, I mean, what do you think is the most kind of disruptive risk that you think, is likely, so to speak?
I think, from a macro standpoint, there's risk of the market feeding on itself, right? Like Bitcoin driving down tech valuations, driving down China stocks, driving down emerging markets, driving down the rest of the things. Or there's risks of a Fed policy mistake. I think all of those things are well understood and to some extent self-regulating. For instance, if financial conditions were to tighten, then the Fed would become more dovish. So there's a level of equilibrium around these things that I think is well captured, I would think. The one, I would say, risk that I think that from a macro standpoint is the least appreciated is it's what we saw, elements of which we saw in the University of Michigan print, a place where because of the price spikes, the momentum in the economy starts to fade quite quickly. And you have seen elements of that, not just in consumer confidence, you have seen it also in the housing market, where the data starts to roll south in a meaningful way now. So people are focused on the inflation side, but what if these price spikes actually curb demand on a forward basis?
Yeah, no, that's a really good point. Yeah, because at the moment, people have a relatively rosy growth view, and the risk they're seeing is inflation spikes. But if growth ends up being on the downside, if the downside risk to growth is something that people aren't really focused on. Just outside of kind of market views, one question I have for you, obviously you're very experienced, you've been on the sell side, you're at Goldman, UBS, and now you're on the buy side. I mean, what's your sort of process that you use to come up with a view?
So I think that's a good question, I guess. If I was to summarize it in one place, I would say that I'm trying to think of the nature of the shock that is hitting us and to understand A, its regional origins, B, its policy implications and macro implications, C, the linear impact that it has on assets in some kind of stylized way. And once I lay those things down, try to understand the nonlinear risks around these developments. And there are different ways you can approach it. You can do it either thematically, if there's a thematic kind of a situation, or if it is about, one of the big sort of like growth centers, US, Europe, China, EM, you can do it in a stylized way where you have your models where you have a growth shock or a policy shock and you model it. But for me, one of the things that I've learned and as a tool that I tend to use the most over my career is that when it comes to macro, understanding the impulse is one of the most traded things. And I think that a lot of people are focusing on more static assessments, and that's where I find things to disagree with. For instance, the inflation discussion is a good one. If you have focused at any given point in time in levels of activity or capacity utilization, you would have come up with the wrong kind of a theme. Whereas if you have focused on the impulse, you would have been able to forecast A, the sequencing of our asset moves, and B, the point in time that it's worth fading. So I think understanding the impulse from different developments and the shock and analyzing that, I think is in stylized and framework-based ways, I think is one of the things that I use the most, if that makes sense.
Yeah, no, absolutely. It does make sense. And I've noticed you do like to model things a lot, so you like to crunch the numbers, do the analysis. That's an important part of your process.
Yeah, I think that there's very often the market relies on narratives, and narratives work up to the point that they become unrealistic in terms of their assumptions. And when you do some easy number crunching exercises and you get a different result than what the market is giving you, I think it's a very, very powerful kind of outcome.
Yeah. And then, again, kind of sticking to the process side, another thing, and this is something, I think a lot about Macro Hive, and we think, at personal level as well, is, how do you manage your information and research flow? Now that you're on the buy side, presumably you get a lot more kind of incoming research. There's all sorts of other sources you have, whether it's the news media, working papers for academia.
Yeah, so you end up in a place where it's uncomfortable because, you remember, you and I are probably more or less similar cohort in terms of our careers. When we were starting our careers, sending an email was super powerful. Now, email is so overused as means that inboxes are becoming unmanageable. So, by default, the process ends up being a suboptimal one where you have to focus on the 2 or 3 people on the street that do the best job per subject and follow those and per country or per asset or per subject. And that is a suboptimal process because there's a lot of very talented, very smart people out there that are trying to make their names with good work. And you inevitably tend to miss out on some part of what they do. But overall, I think you end up in kind of dimensionality reduction exercises, I would say. My main complaint here about is that the supply of research has become a lot more about volume and a little bit less about innovation, if you know what I mean. And particularly in our space, which is asset prices and strategies, etc. I think that back in the days there was a lot more risk-taking attitude from research houses. Not blaming the researchers, I'm talking about the approach mostly. I think MiFID has done that to research.
Yeah, no, I'd agree with that as well. That's what I kind of found. Just the regulatory structure, compliance structure, just the management risk appetite. It's much more towards don't screw up, don't do anything that will screw up, so don't have a clever headline even for your piece, or just don't do anything that has any downside. And by definition, if you do something that's innovative, then there's some risk around that all. Yeah, no, I hear you on that one. Now the final thing I wanted to ask you, I love my books, and so I'm always on lookout for good books. And so are there any books that really influence you in terms of the way you look at the world, or are there any books recently that you've really liked?
Yes. I'll mention, I'm not sure if these are necessarily recent books or something that is too innovative or different compared to what people generally have in mind. But one of the books that basically has always fascinated me is a book by Galbraith, John Kenneth Galbraith, which I don't necessarily value as much as an economist, but he's a great economic historian, was a great economic historian. And he wrote a book called Economics in Perspective. And the main point of the book has been how economic innovation in economic thought is something which is laughed at the time that it's being created, and it's fought against by the dominant ideas, but then it becomes so dominant that basically it suffocates future ideas. So that struggle between something that is innovative and then becomes an establishment and then it traps people thinking around it is something that markets have struggled with in both terms. Sometimes market extrapolate a little bit too much. Sometimes markets extrapolate stability for a little bit too much. So I think that has been one of the books that I always sort of go back to in terms of how thought was formed over the years in economic thought. And in terms of non-economic stuff, there's a great book which I have found very relevant for politics. It's a very difficult book, so I read it younger. I don't think I have the brain cells anymore to go through it. It's called Theory of Justice by Rawls, and it touches on many different subjects. It's the place where this veil of ignorance was first sort of established in a more formal way, but it shows a very good way of how to understand what is fair. And there's a lot of very difficult subjects that are very important for our time, particularly for what happened in the United States in the last presidency. For instance, there's a book about the limits of tolerating intolerance within a democracy. There's a very good chapter. I found these subjects very fascinating. They're not marketing related, but I did want to put them out there as two great reads.
Yeah, no, I like those. I've never read Rawls' kind of original books. I've kind of read summaries of his thoughts, and I do appreciate his thinking. And now that you mention that the book's quite heavy, I'm even more scared of reading an original text by him. But certainly Galbraith, he's a fantastic writer. Well, he was an amazing writer, which was always a lot of fun to read. I actually met him when I was at university. I was kind of head of their University Economic Society, and we used to have guest speakers. And so we invited him as a speaker, and he accepted. So he came along and with his wife, and he gave a talk, and it was amazing.
He's a great thinker. He puts a lot of things in perspective.
Yeah, absolutely, yeah, and a lot of common sense. He comes from the practical world as well, which I think makes a big difference. So
I'll put forward one last bit reading, but it's a lot of fun. Romer, who just recently got a Nobel Prize, right a couple of years before he got the Nobel Prize, he wrote an essay called "The Trouble with Macroeconomics." I highly recommend it. It's the most hilarious thing you've read, but it's so true, and it goes down into the core of mathematical economics today by a guy who really understands it. It's a fantastic read.
Okay, I've got to read that. Yeah. Okay, sounds good. Sounds like it's a good fun read. Maybe sort of depressing, maybe as well. That's all great. So with that, I just wanted to thank you for the great conversation. Now, is there a way people can follow your work or reach out to you? I know you're on the buy side now, so it might be tricky, but is there some way people can follow you in any way?
Well, I always love to talk because, I need the exchange of opinions to understand what I'm missing. So, either by Bloomberg, or if people would like to have a one-to-one discussion, that's the best way. I'm afraid we're not publishing anymore. So in that sense, yeah. But anyways, Bilal, thank you so much as well for your time. Keep up the great work that you're doing. You're doing one of the most blue sky thinking out there about what research is and should be. So congratulations. And thank you again for the time that you gave me.
Great. Pleasure. No, thank you as well, Themos.
Cheers.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating and a nice comment. Let other people know about the show. We'd be really grateful. Also, sign up to become a member of Macro Hive at macrohive.com. We'll be back soon, so tune in then.